Every morning, billions of people wake up and chase money. They chase salaries, rent, loans, bills, groceries, business deals, and investments. But almost nobody stops to ask the most dangerous question. Where does the money actually come from? Most people think the answer is simple. Governments print it, presidents spend it, central banks control it, commercial banks store it, and ordinary people work for it. But the real system is much stranger. Money is not controlled by one person sitting in a dark room. It is controlled by a layered machine. And once you see the machine, you realize something uncomfortable. Money is not just paper. Money is permission. It decides who can buy a home, who can start a business, which companies survive, which countries collapse, and who gets rescued when the system breaks. So when people ask, who controls the world's money, they are really asking, who controls access to survival? The answer is not one bank, not one government, not one billionaire. It is a network. Commercial banks, central banks, governments, asset managers, payment systems, and now big tech. And the first layer of that network begins somewhere very ordinary. A person walking into a bank and asking for a loan. Most people imagine banks as warehouses for money. Depositors bring money in, borrowers take money out. Simple, safe, logical. But modern banking does not work that simply. When a commercial bank approves a loan, it creates a new deposit in the borrower's account. The borrower gets spendable money, the bank gets an asset called a loan, and the money supply expands. That is the hidden shock. Much of the money people use every day is created when banks lend, not because a banker opens a secret vault, not because a truck delivers cash, but because modern money is mostly accounting entries inside a regulated banking system. That does not mean banks can create unlimited money with no consequences. They are limited by regulation, capital requirements, customer demand, risk, and central bank policy. But it does mean the popular image of money creation is wrong. The printing press is not the whole story. The loan desk is just as important. Now think about what that means. If bank lending creates money, then credit is not just a financial product. Credit is the bloodstream of the economy. When credit expands, the system breathes. Businesses hire, homes sell, markets rise, people feel richer. When credit contracts, the oxygen disappears. Loans become harder to get. Spending slows. Asset prices fall. Fear spreads. So the next question becomes even bigger. If commercial banks create money through lending, who controls the conditions that make them lend or stop lending? That takes us to the second layer. Central banks. Central banks do not personally approve your mortgage or your business loan, but they influence the price of money itself. That price is the interest rate, and interest rates are one of the most powerful levers in the modern world. Lower rates make borrowing cheaper. Cheaper borrowing encourages companies, households, and investors to take more risk. Higher rates make borrowing more expensive. Suddenly, the same house costs more per month. The same business loan becomes harder to justify. The same market valuation starts looking too rich. This is why central bank meetings move markets within seconds. One sentence can change expectations. One chart can change billions in asset prices. But central banks are not all-powerful magicians. They cannot print real productivity. They cannot create affordable housing with a speech. They cannot force banks to make good loans. What they can do is shape the environment. They can make credit easier or tighter. They can rescue markets during panic. They can change the incentives of everyone else. During crises, this power becomes obvious. In 2008, and again in 2020, central banks used massive asset purchases to stabilize financial markets. The stated goal was to stop collapse, and in many ways, it worked. But the side effect was harder to ignore. Asset owners benefited first. Stocks recovered, bonds rallied, housing prices surged in many places. Anyone who already owned assets felt the rescue quickly, but people living paycheck to paycheck experienced the rescue differently. They saw rent, food, cars, and housing become more expensive, while wages struggled to keep up. That is one of the darkest truths of modern money. Stabilizing the system often means stabilizing asset prices, and asset prices are mostly owned by people who already have money. So when people say central banks control money, the more accurate version is this. Central banks control the temperature of the room where money is created. But there is another layer above national central banks, quieter, older, and far less visible to the average person. In Basel, Switzerland, sits the Bank for International Settlements, known as the BIS. It is often described as a bank for central banks. The BIS does not control your bank account, it does not decide your grocery bill, but it gives central banks a place to coordinate, study risk, and discuss the rules of global finance. That sounds boring. But boring institutions can be extremely powerful because they shape standards long before the public understands what changed. Power does not always look like a throne. Sometimes it looks like a committee, a standard, a risk model, or a rule nobody votes on directly. And if you want to see financial power in its sharpest form, look at payment networks. Money is useless if it cannot move. A bank balance is only powerful when the network allows it to travel. That is why systems like SWIFT matter. SWIFT is not a magic money pipe. It is a messaging network banks use to communicate payment instructions across borders. But if a bank or country is cut off from major payment networks, doing business with the world becomes harder overnight. That is monetary power without tanks. No invasion, no missile, just access removed. Now add another layer, international lenders. When countries run out of options, they may turn to institutions like the IMF or World Bank. These loans can prevent collapse, but they often come with conditions: budget cuts, reforms, privatizations, and policy changes that reshape entire economies. So the control of money is not always about who has the cash. Sometimes it is about who writes the terms when everyone else is desperate. At this point, the money machine is already bigger than most people imagine. Banks create credit, central banks shape conditions, international institutions set rules during crisis. But money does not only control through currency, it controls through ownership. This brings us to the asset managers, the quiet giants that hold the retirement savings, index funds, pension money, and investment portfolios of the modern world. BlackRock, Vanguard, and State Street are often called the Big Three. Together, they manage enormous pools of capital and hold major stakes across public companies. To be clear, they do not own all that money for themselves. Much of it belongs to ordinary investors, retirement savers, pension funds, and institutions. But the firms often sit between the real owners and the companies. And that middle position can carry influence. They vote shares, they engage with boards, they influence governance, and in a market where passive investing keeps growing, their role becomes harder to ignore. This is not control like a dictator controls a country. It is influence through ownership, scale, and default position. And the larger these firms become, the more one strange question appears. What happens when the savings of millions of ordinary people are concentrated through a handful of financial gatekeepers? The next layer is risk technology. BlackRock's Aladdin system, for example, is used to analyze risk across portfolios and institutions. A risk system is not a government. It does not pass laws. But if enough powerful institutions rely on similar models, then models can influence behavior at massive scale. That is the hidden modern shift. Power is not only in who owns the money, power is also in who designs the dashboards everyone trusts. Now, enter big tech. Banks may create deposits. Central banks may shape rates. Asset managers may direct capital. But big tech increasingly controls the front door. Your wallet is moving into your phone. Payments are becoming apps. Credit is becoming embedded in checkout screens. Financial behavior is becoming data. That means tech companies may not need to become banks to shape money. They only need to control the interface between you and your money. The company that controls the interface controls the habit. The company that controls the habit controls the data. And the company that controls the data gains leverage. This is why the future of money may not look like a bank branch. It may look like a phone screen asking for your face, your fingerprint, and your permission. And that brings us to the most controversial layer: central bank digital currencies. A CBDC is digital money issued by a central bank, not a bank deposit, not a private stablecoin. Central bank money in digital form. Supporters say CBDCs could make payments faster, cheaper, safer, and more inclusive. Critics warn they could create new risks around privacy, surveillance, control, and government overreach if designed badly. The terrifying version is programmable money, money that can be tracked, limited, frozen, or set to expire. The better version is privacy-protected public money that works in a digital economy without giving one authority unlimited visibility. So the question is not simply whether digital currency is good or bad. The question is who designs it, who governs it, who audits it, and what rights users keep. Because technology does not remove politics. It hard-codes politics into the system. At this point, the machine is complete. Commercial banks create much of the spendable money. Central banks shape the cost of credit. Payment networks decide access. Asset managers influence ownership. Big tech controls interfaces. And ordinary people stand at the bottom using the system every day, usually without seeing the levers. So who really controls the world's money? Not one person. Not one secret family. Not one hidden button. The real answer is more boring and more powerful. Money is controlled by institutions that control creation, cost, movement, ownership, and access. Creation belongs largely to commercial banks through lending. Cost belongs heavily to central banks through rates. Movement belongs to payment networks. Ownership belongs to capital markets. Access increasingly belongs to technology platforms. That is the architecture. And once you understand architecture, you stop being distracted by the paint on the walls. You stop asking only, who is president? And start asking, who sets rates? Who issues credit? Who holds the assets? Who owns the pipes? This is not saying politics does not matter. Politics matters. Governments set laws, budgets, taxes, sanctions, and guarantees. But money power often survives election cycles because institutions, contracts, payment systems, and balance sheets move on longer timelines than politicians. That is why the system feels untouchable. It is not one wall, it is a maze. And the maze works because most people are too busy surviving inside it to study how it was built. But once you understand the machine, you can make better decisions. You may not control interest rates, but you can understand what rising rates do to debt. You may not control banks, but you can understand that credit booms create risk and credit contractions expose weakness. You may not control asset managers, but you can understand that ownership matters more than headlines. You may not control payment networks, but you can understand that access to money is as important as money itself. And you may not control the future of digital currency, but you can demand privacy, transparency, and limits before the system is built around you. That is the real purpose of financial education. Not to make you paranoid, to make you harder to manipulate. Lesson 1. Money is mostly digital trust. The number on your screen matters because the system agrees to honor it. Lesson 2. Debt creates money, but bad debt destroys freedom. The same loan that builds a business can trap a household. Lesson 3. Interest rates are not abstract. They decide the monthly payment, the business expansion, the asset valuation, and the pain level. Lesson 4. Ownership is power. The people who own assets are closer to the money machine than the people who only earn wages. Lesson 5. Access can be weaponized. When financial networks close doors, money can exist on paper but become impossible to use. So the smartest people do not just ask, how much money do I have? They ask, what system am I inside? Because if you do not understand the system, every crisis feels random. Inflation feels random. Rate hikes feel random. Market crashes feel random. Currency collapses feel random. But once you understand the levers, the chaos starts to look like a pattern. Not a perfect pattern. Not a secret script, but a structure. And structure is what most people never see. Money was never just a tool for buying things. It is a language of power, a map of trust, and a system of control. The people who understand money's hidden mechanics do not need to shout. They already know where the levers are. And now that you see the machine more clearly, the real question is no longer who controls money. The real question is, how will you move inside a system that was built long before you understood it. Drop your thoughts in the comments, hit subscribe, and I will see you in the next one. If you enjoyed the story of who really controls the world's money, then you'll love the story of the billionaire who built a $200 billion empire from almost nothing. Click the video on your screen now. I'll see you there.